Hey guys, Sage here. So I haven't done recap videos in a little bit. I will talk to you today about trades that I've taken and things that I'm looking at in the market. So obviously it's no surprise, right? All of us are pretty baffled by the moves that we've been seeing in the market. This is going to be a longer video, all right? I generally say it's not, but usually it is. I have a big mouth. I talk a lot. There's a lot of information that I would like to share. I will give you trading ideas and things that I want to buy into. So I took some time last week. I've been working specifically on some things that you can pretty much see on my chart what I've been working at. I don't have anything really to hide. I've been working on a trading system that's a little bit more quantitative. And I'll discuss that because this is the reason why I had my biggest futures trading day ever, right? I had multiple five-figure days, five-figure trade here today. And I still have one active on VX. I will explain all of that, right? So I would hunker down here. If you want to watch me in 2x speed, that's perfectly fine. There's a lot of details that I'm going to be discussing, and I'll talk. I want to recap the trades that I've taken first, right? So I took 4 trades today. I should have taken 6. So I haven't really been sleeping on the volatility that we've been seeing in the market. I know you guys don't care, but I'm just saying that because the first trade that I caught was close to 4 o'clock in the morning, right? So I caught this trade. I literally caught this trade. So I have a control here. So I've been working on this little project of mine, and what I mean by control is I want to know where the moving averages are, right? Because I'm a moving average trader, but that's not the only thing that I'm using in terms of confirmation. I like to use volume, and I always like to use some sort of momentum or some sort of oscillator. I've been trading for a long time. So the way that this indicator works, or the way that any trading system should work, it should be based off of confirmation. So here, there's several of them. This is not very different than my moving averages. I like using the 5 and the 21. I use it because for me, it's a healthy balance between fast and slow. In this case, medium. The 21-day moving average is very medium. So I'm going to explain the trades that I took. I'm going to break that down first, and then I'm going to talk about certain positions that I'm in. I'm not going to gatekeep anything. I'm going to give you everything. I'm going to tell you what positions that I'm in, and I'm going to talk to you about shorting volatility. I've done it my entire career. I have never not shorted volatility and not been successful. It's pretty much as close to a guarantee as you can get, because if you understand dichotomies in economics, and if you just understand how volatility works, volatility reverts back to the mean. It's always going to, right? Because you're not going to have volatility expanded or it's not going to be high forever. I wanted to be technical there, but I don't have to be overly technical. So 4 o'clock in the morning, I'm up, right? I'm pretty much up for 36 hours straight because market is making me nervous. I'm down a significant amount in my portfolio. Now, depending on if you're in our Discord group or not in our Discord group, let me be very clear. I have not been doing a good job with the short-term signals per se. I just haven't, right? I really don't like eluding anyone. It just hasn't gone well since January up until right now. But I'm looking to change this. I'm looking to be obsessed with what the next chapter of my trading career is going to be. And for me, it has a lot to do with trading futures. So I've been trading it more and more. And I want to share with all of you that are watching what I'm doing, but not because there's something magical about what I'm doing. I hate when people bring that up. There's nothing magical about trading. It's all quantitative. Quantitative is just a fancy word for saying several calculations that are being done in order to drive a result. That's what trading is about. It always has been about that. So without further ado, why did I take that? Why didn't I take these signals right here? The reason why is when I'm looking at specifically my oscillators right here, notice that there is a lineup where the TTM is. So the TTM was already giving me indications of firing. So I could have had that right here. I didn't take that signal. I didn't take this one either because we were pretty flat on the TTM. But this one in particular, I did take. I literally took this and I rode this out until I was stopped right here. So 21-day moving average, not that difficult, and then stopped out about there. I made 270 points off that trade. I have to look maybe 265. I don't know how many points you're looking to catch on your futures trades, right? A lot of you are trading more futures, and so am I, because I can see how I can take this to the next level. Like, I like to plan out everything. I'm usually doing models for my investments, I've been moving things all over the place. I am down More money than you'll ever know. I'm down a lot of money. I'm down a significant part of my portfolio, right around the threshold of 50%. So my net worth has dropped significantly. That's why I'm in this obsessed mode. So this one trade already looks pretty good, right? I didn't trim out this trade. I was just monitoring it. I was looking at, I was actually working. I was working around 4 or 5 o'clock in the morning. And then I'm looking at my alerts because I have this set up on my phone. And then I say, okay, let me look at the chart here. Fired the trigger on the trade. So then what else am I doing? I'm preparing for the trading day. I have no idea. I have no idea how it's going to go. I use something called the voodoo lines. The voodoo lines, since I purchased them, they have become significantly well priced, right? I paid, I think it was $3,700 at the time for this indicator. I think you can get them now for about $700. In my opinion, I think they're a good investment. If I'm going to be trading long term, I'm going to buy them. So I bought this a couple of years ago, and it's been quite a ride. But now I feel like I'm starting to put certain pieces together. So the first piece that I want to discuss is this position right here. Let's remove the 21 and the 5 EMA, and let's just look at this one position that I thought was interesting. So why did I not take this position, and why did I take the first position? Let me explain this. I'm going to bring up the CVD, which is basically the cumulative volume delta. All this is telling you is if we are accumulating in one direction or the other, how much delta is below or above a specific threshold. So in this situation right here, the zero line, it acts very similarly to whatever zero threshold that you have on any other oscillator. It's not different. This is just representing a volume, right? So you have regular volume delta. This is what I like to use. What did I identify that for me was like, okay, maybe I'm interested in this trade or not? It's not that volume bar. No, because I can't tell the future. Nothing that I do is predictive. Everything that I do is detective, right? Because I want to detect things. There was a little bit of an elevated candle on that, right? So if you're looking at the average of what was trading for pre-market, or excuse me, after hours, so that's a proper term, there was a little bit of an uptick right here. So this fired. This said, okay, maybe you have a move here to catch. So I did. I caught that move. And how many points did I move there to the downside? So I literally fired. I have something on this indicator that tells me, hey, you're meeting several conditions. There's about 4 or 5 conditions that I like to be met. And this is not anything fancy. All it is, it's thinking like I would and giving me a visual representation of whether or not I want to take the trade. So it did do that. It actually did do that. So let's point that out. I took the trade approximately right there, one third of the way of the candle. And where did I get stopped out on this position? I wrote it down to approximately when we hit right there on that candle. So that's about a 120 point move. I thought that was already pretty good. But then we had this massive wick, literally massive. Just check that out. I thought that this was a massive wick, but you'll see in a second, like I was totally wrong. So that wick is 285 points. So these are not normal circumstances. When someone says to me, we moved, 300, 400% intraday, or not percent, points intraday, I'm like, okay, that's a huge volatility wick. All right. So I know there's volatility in the market, but remember what I was talking to you about where we are in the TTM and specifically looking at volume. I'm a volume-based trader, and I also like looking at moving averages. When those two things line up, then for me, there's a recipe for possibly a high probability trade. So follow along with me here for a second. I don't want to lose you, right? I really don't want to lose you in storytelling. I want you to understand why I took the trade in the first place, because I don't want you to think, hey, Sage has all these pretty little lines here, but like his system doesn't make any sense whatsoever. I hate that. I hate that about traders where they're looking at price action. They're like, I kind of feel it. I don't care about your feelings, homeboy. I care about, can you identify a trigger and what are the conditions that would ultimately decide for you? You see what I'm saying? So if I have that decision to be made, I want 2 or 3, maybe 4 or 5 conditions to be met. So I had that here. I definitely had that here. I was looking at the snow line. So snow line was telling me, hey, I'm moving off momentum because this is my momentum oscillator. It's right on the candles. And then I lost that threshold. Obviously, I lost it here. And then as soon as we started picking up on that volume, my TTM wasn't telling me much, right? But remember, I have more than 1, 2, 3. I have several conditions that I'm trying to catch. So that condition was met, denoted there by that arrow. So move down, and then we actually hit the fire line, right? We hit it. We definitely hit it. So from snow line to fire line, how many points is that? Yo, that's a massive move, dude. It's 300 points. right? It's 300 points. I caught 2/3 of this. So I was like, okay, so we had a good day, and more than likely we're going to be trading lower. Be careful, right? I've honestly, to be perfectly honest, I've always traded without a singular bias because I've always been an option seller. So I don't care what the market is doing. So long as it stays within a specific area or a band, I'm good. So when this fired right here, what did I notice? I want you to pay attention to two things because this is my trading strategy. There's no secret to it, right? I'm not gatekeeping. There's nothing aside from what I'm showing you here that is going to prompt me taking the trade or not. It is all based on volume, and it's all based on holding a threshold and then seeing if that momentum is going to catch wind in its sails. In this situation, this is probably the biggest candle or the biggest trade that I have ever seen intraday for as quick as it moved. Because this thing, I can't believe that I actually caught this trade. I really, really can't believe it. So we bounced off the fire line, which was 685. So what was my entry? My entry was 690. That was literally what my entry was. So 690 is right here, just below the snow line. Now, I want you to think about something. I don't want you to say, all right, so this guy caught a banger trade and he knows something that I don't. No, I don't. I don't know anything that you don't know. It's just about what indicators are you using and which are the ones that are lining up, right? Because we want this to be quantitative. We don't want this to be voodoo magic, right? I know I use the voodoo lines, but this is not black magic. That's not how it works. That's not how the larger institutions are trading. They're using very similar tools to what we use. We have a lot of tools that you got to pay a little bit of money, but you have access to. All right, so let's go back here to this trade. Did I know that we were going to move 1,200 points? I'm looking at the Discord. If you're in the Alpha channel, I'm watching this video, then you know how I outlined this trade. I said, hey, look for a long off the short that we just caught. And then I don't think I believed myself. I was like, I don't know what's going on here. So let's check out the 5-minute time frame. I'm going to share with you what setup I actually use. I was using the 5 and the 10. Okay. I used 2 confirmations. So you're probably saying off the 10-minute time frame, there's no way this guy would have caught 690. You're right. Off of the 5-minute time frame is what I was looking at. I use the 5 and the 10-minute as a 2 time frame confirmation on whether I want to take the signal or not. Why do I use the larger time frame? The larger time frame gives me the larger context of structure. That should make sense. If you've been trading for more than a year, maybe 2 years, and if you're very studious, then this setup is not, it's not avant-garde. For sure, it's not avant-garde. So let's remove, because I already know that we're doing some calculations here, and I can pretty much see the volume. So the TTM missed out. The TTM was nowhere to be found. Had I used only the TTM, I would have not caught this trade. So I was specifically looking at a threshold. That threshold, you have 2 of them. You have a trend analysis that's going on here, and then you also have the calculation via the VWAP. The VWAP, the TWAP, not the same calculation, but very similar thought process. So you're looking at the time-weighted average. We were above that threshold, so that's why it fired the signal right here, right? So we got that signal fired, and we got to have this signal fired. Did I know that we were going to break above 13 different price targets? No, I did not know that. I'm going to share with you all of them. So we have from this entry, basically at the fire line, from here, I thought I took 3 contracts. I was like, I think I'm good. But the candle didn't stop. So what did I do? I just moved up my stop loss. I moved it up by 50, 60, 70 points. For me, I'm catching 50, 60 points on a futures trade. Homie, I'm good. For me, that's okay. I catch 4 or 5 of those trades every single day, and I'm good. If I get stopped out at break even or little losses, this all is to say that if I'm catching 60, 70, 80 points on the day with futures, I'm already very happy. I'm extremely happy. So first threshold, and then this gargantuan, this kraken of a candle, this thing that went from 0 to 10,000 in basically 5 minutes, I was not prepared for. So we had our moment. I had my moment too. I was like, I can't believe what's going on. So this thing shot up literally like a rocket. So how many points did we go and how many thresholds did we just absolutely obliterate? We went through here. That's 250 points on NQ with 3 contracts, right? And then after that, it just didn't stop, man. 450 points. And maybe I'll include a screenshot. I don't know if I'll have time to edit this, but in the channel, I was like, yo, we're up 300 points. Dude, I'm looking to clear this trade off. We didn't do that. We didn't do that because we didn't see any signs of weakness. We didn't. It just kept on going. I ultimately decided to take this trade. I took almost 970 points off this trade. So I didn't take it at the peak, right there at the top. I waited for the candle to settle a little bit, and I believe I took it off at, I have to check the board there, but I believe I took it off at 200. Right. So this is just a gargantuan trade. It really was. So I caught the short and then I caught the long. And then you're probably asking yourself, Sage, did you not catch that short position? I'm going to tell you now. I'm going to tell you right now that I did not think about anything else aside from this massive trade that I took. So ultimately, how many trades did I take so far? I took 3. I told you that I took 4 today. I'm going to explain the volatility trade here in just a second. But I want to just outline to you guys, it's not necessarily about the indicator per se. It has nothing to do with the indicator. It has everything to do with you understanding your tools, and from your tools, you applying the right risk reward. Believe you me, I was trailing up my stop loss. I wasn't doing it aggressively. I really wasn't. But I trailed. I keep on getting alerts here. Trailed until I finally got stopped out. I'm not going to give up 400 points. I'm just not going to do that. This was, I think, maybe if I hit this trade again, I'll probably be in the next, I don't know, 3-4 years. I don't know. But this is not a usual wick. This had an intraday move from top to bottom, I believe, of 7.5%. So I caught that, not at the perfect bottom. How many points did I give up from my entry? Let's look at perfect bottom and look where my entry was. So I got in right here at 690. I gave up almost 300 points from the bottom, but I put myself in a situation where if I'm managing the trade correctly, if I have the right risk reward, and then if I'm not emotional, I wasn't emotional in my trade. Not at all. I was excited. I can't tell you that I'm not excited. I was very excited, but I couldn't believe by what I've been working on that I caught not just the candle to the downside, but the freaking reversal, right? I can't tell you, I can count on one hand how many times that I've done this in my career. So I was excited to see that. This element right here about catching the short, it would have been overzealous and it would have been greedy of me to do that. I didn't do that. This element is actually something that I added recently. But you're probably thinking, you're not following any methodology here. What's the trading system? What is were the moving averages crossing there? That's the right question that you need to ask. And I'm glad that you brought it up. If you weren't thinking that, I thought it for you. So let's look at our control. Why do you think I did not take that trade? It's because right here, I detected the moving average cross on the 5 and the 21 by my quantitative analysis, right? So it caught wind of that. So it caught wind here, and then it also caught wind right there. I'm not going to catch the perfect bottom, and I'm not going to catch, right, the perfect top. That's not how trading works. But why do you think that I caught the short and the long? It's because just using the 5 and the 21, this should make sense to you. They crossed. Right? So I got my indication, and then I had this really fat ass candle that came in right there, and I was like, holy crap, I cannot believe we are moving 4.5, almost 5%. So this is where the 5 figures comes in. Yeah, it was a large trade. I'm not going to say it's not. I trimmed out of this trade, and then I left one runner. It was a huge trade. It was probably the best trade of my career. I would say for futures, at least thus far. So I didn't get the 5 and the 21 cross. After, I'm thinking, well, why didn't I take that short? Because we were massively overbought at that point. Now I have some different quantitative analysis that I'm looking at and that I've implemented in my detection system on why it isn't that I didn't take that short. It would have made sense. Now, I understand the calculation behind how this was signaled. Because if I don't have confidence in the tool that I'm using, I'm not going to take trades. That should make sense to you. The indicator or any quantitative analysis or any sort of automation that you create for yourself, which I'm doing for myself, if you do not understand how that automation or how that code works, you are not going to trade it with any confidence whatsoever. Why did I have confidence here? I had a control. My 21 was here, my 5 and my 21. So I don't have that indicator right here, but I was using specifically this. I want to see that my little, Jimmy rigged indicator here is lining up with me getting the buy or the sell signal, and it did. You see what I'm saying? And it also lined up, check this out, it lined up with the CVD. It didn't line up with the TTM, but I saw massive candle come in, massive volume come in. I'm like, all right, I think it's time to tango. Now, if you're looking at the CVD right here, I'm explaining to you how my trading system works, so bear with me. I'm looking at that and I'm like, I'm just saying to myself, why did I not catch wind of that? I'm not trying to be predictive. I can't be predictive. It's impossible. But I can at least be detective. So as soon as that trend reverted, this was a deep V. I thought that I would never be able to even compute or calculate how on the back end, like how I can actually detect these kinds of trades, but I was able to do it. So is it going to catch every turn, every move? Well, let's check that out, right? And I'm going to tell you the fourth trade here in just a second, but I'm getting excited just even explaining this. So am I going to detect every little turn? Well, I'm starting to get decently good at it. I mean, am I going to take every single little trade? Well, this is going to depend a little bit more on the 21 and the 5-day moving average. So wherever we line up, probably I'm looking at something very similar to if that trade is lining up with the 5 and the 21, maybe I like it, maybe I don't like it. So you guys are seeing, all right, there's a lot of signals going up and down here, and you're absolutely right. Any trading system will, I mean, if anyone is really transparent with you, will tell you in chop situations or in whipsaw situations, it's very difficult for you to point out exactly where to take your position. It's pretty much impossible. Are we correctly identifying every time that this has 100% accurate turn? No, of course we're not doing that. But I recognize the pitfalls, and I recognize that if I'm going to use quantitative analysis, I'm going to use the proper risk reward. It's not about the indicator being 100% correct 100% of the time. No, it's not how that works. But it is about you identifying when the conditions are not conducive for your trading strategy, then you have to set your stop losses accordingly. So in this situation, let's say yesterday's price action, how many trades would I ideally have caught if I was just using this right here? Would have caught a pretty decent trade right there. I would have been stopped out. Decent trade right here, very similar to the short position that I took this morning. Would have been stopped out here, would have been stopped out here. More than likely, I would have been stopped out at break even or a small loss here. Wouldn't have worked. Here, probably would have worked with maybe about a 40-50% move, and here it wouldn't work. So overall, the trend is down, but check this out. This is something that I think is really, really cool. What takes precedent here is maybe the first signal that was given, right? So the first signal was given maybe about what? A couple hours before market open, right? So it's really, really early. Let's remove the 5 and the 21. I'm not saying this. I'm not saying this because, oh, I'm going to catch this trade and I'm going to ride it all the way to the down. I'm not saying that. I'm saying that the overall trend per the trend analysis was identified here. And then I would have been stopped out on the trade. So overall, it seems like this is catching moves or analyzing trends quite efficiently. Where it's going to underperform, where I'm going to underperform, which I think most traders do, is when we're in very choppy markets. But Sage, why don't you code that a little bit further back? It's because if I'm coding for specifically the situation, then it's not catching the other conditions that I know are generally high probabilistic trades. Does that make sense? I don't want to code for one trading day. I'm okay with here if I hit 3 stop losses and I take, let's say, 3 break-even trades, and then at the end of the day, I'm down like 60 points. I'm okay with that. I'm very, very okay with that because I know that when we line up for some good trend days, when there's an actual trend to be caught, then I know that more than likely I'm going to catch them, similarly to what I did today. So you guys are dying to know what is my fourth trade. I took a short trade on VX. I'm going to talk extensively about this. Remember what I said in the beginning of the video? It's going to take me some time to talk through my thoughts and journal what it is that I'm thinking, because I use this also as my journaling platform, because I want you guys to follow a thought process. And a trader that does that, I try to trade every single day. I want you to understand what it is that I'm looking for and what it is that I'm seeing so you guys can emulate that. And for your risk parameters and for your financial goals, you can say, okay, this aligns with what I want. This doesn't align with what I want. This makes sense for my psychology. This does it. And then you guys go from there. Cool. So on VX, what did I do here on VX? I specifically took this trade right here. So let's just remove this just for a second. And let's remove that. And I want to show you why I took this trade the way that I did. So look at the conditions. Where is the 5 and the 21 cross? Specifically on, let's look at the 15-minute time frame. Specifically on the 15-minute time frame, I identified this a little bit earlier. So this is where my experience comes in. This is where my experience is going to come in. I want to look at the 5 and the 21. I know that we jumped like crazy. We absolutely jumped like crazy on all the volatility indexes. I know based off of just just my experience, that when the VIX trades up a specific threshold, I'm going to share with you what the VIX is. That threshold is all the way up here. When we trade at these levels on the weekly time frame, never mind the 5 and the 21 right now, we do not sustain these levels. So if you're new to trading or if you're not new to trading, we don't stay above the 35 level on the VIG. We don't do it for long periods of time. So this is called reverting to the mean. It is a very well-known concept in trading. It's an extremely well-known concept. So when are we going to revert to the mean? I knew that we already broke above the $45 threshold or 45 level. And right now, I wish that I shorted it at 57. Honestly, I really wish that I did do that, but I didn't do that. Now, what was my vehicle of choice? I cannot short the VIX with futures, but I can do it on something called VX. So this is where I'm going to share with you my trading idea. This is something that maybe you're not going to catch now because I'm just a guy on the internet and you're like, all right, this guy's an idiot and he doesn't know what he's doing. That's fine. That's fair to say for the last 2.5 months. I'm going to take that criticism. So on VX, what was the highest point that we saw pretty much last? That was during COVID. And what levels are we generally sustaining or not sustaining? So what is this peak point right here? This is back during the 2008 crash. What about here? So we had a little bit of a crash right there for 2011. All right, awesome. So this doesn't go that far back, but what specific thresholds am I looking for? Do I really sustain above, let's say 40 for long periods of time? It doesn't look like I do. Let's check out the daily time frame. Doesn't really look like I sustain these levels all that well. So I'm going to tell you, do your own research. Don't depend just on me. But with each point that moves, either up or down, if you buy a VX contract, whether you're buying or selling, if it moves 1 point, 1 full point from 39 to 40 or from 39 to 38, it's going to move $1,000. Those are how those point systems work. So what I'm doing, I'm literally doing this. This is in my portfolio that I'm looking at on the other side of the screen here. On the 15-minute time frame, I looked at the 5 and the 21 cross. Don't do technical analysis on volatility. It's not going to help you. It's just not going to help you. But I'm looking at thresholds. So I might wake up tomorrow and I might be down $25,000. That's a perfectly legitimate possibility. But I have a stop loss. Obviously, I have a stop loss on this. So where did I get in off the 15-minute time frame? Right? Let's look at the 5 and the 21 cross again. So the 5 and the 21 cross right here, right when I was coming at my 40 level, I got my cross to the downside, and then I fired the trigger on that trade. So I took this trade approximately at 37.2. So right now we're trading at 33.43. I took several contracts, so you can do the math. How many? Well, I didn't tell you how many contracts I took, but I took several. So each contract for me, for buying power, it's approximately $8.5 or $8.2 thousand. So I took several. So with each point that we start to move lower, that's $1,000 per contract. So how would you do this as a smaller trader? I'm gonna teach you. I'm gonna tell you exactly how it'll be done. So this would be the VIX, right? Just regular VIX. You're looking at my broker right now. How? Excuse me. What are you going to look to do for futures? Well, you're gonna do VX, right? So VX would be for the larger traders, but most of you are going to be smaller traders. As you know, right? Don't just listen to me, but as you know, we have minis and then micros. With VX, you also have something called micros. So VXM is going to be your weapon of choice. So how would I trade this? It's basically the same thing. You're going to either short or buy in this situation. I would highly recommend that you short volatility. And then how much is this going to run you? How much is each one of them going to cost? It's going to run you, for buying power effect, roughly around $800. So how many of these can you realistically purchase? It really depends on how much buying power you have. So remember, there are cost and commissions to this, right? For each position, it's going to cost you about $1.50. Awesome. But if you're starting to move $1,000 incrementally, right, for each point that you move up, this is going to be a tenth of that. So for each point increment that you move lower, that's $100 that it moves, right? Mathematically, that should make sense to you. So how many contracts of these do I need to make in order for me to take in order for me to make $1,000? Well, if you take 10 contracts in this situation, you probably just want to do VX, but just for example, you want to do 10. If you do 10 contracts, then you can trim out of the position. That's what futures traders are doing right now. But let's say you don't have that much buying power. Maybe you want to take 5. 5 is pretty cool. That's fine. So how would you trade this? You want to send this order and you're going to trade it just like any other futures. It's literally going to be the same thing. So I took my entry right here, right? Every little 0.05 incremental move is $50, right? For the VX contracts, that's how they move. So sweating bullets for every little tick, right? And that's literally what every little tick is literally is pounds off my body because it makes me sweat. But what I know for the long term is that it will decay, it will fall off. Now, be conscious of something, right? If this is not evident, if you don't know what futures are and you're listening to me for the first time, futures do have expiration. So if you want to buy 1,000 of these contracts just because you have a whole bunch of money and you inherited from grandpa, make sure that you understand what the expirations are, right? You don't want to just buy 1,000 of these contracts because I'm telling you, and you probably already know, volatility is going to fall. But be careful because they do have an expiration date. Similarly to futures options, they are two different things. So make sure you know those kinds of things. This is just for educational purposes. Although I did take the position myself, I want to be very clear with my terminology. So what am I expecting on VX? Or I'm going to tell you exactly what I'm expecting. So reverting to the mean does not take us down to 22. That is not the mean. It's actually lower than that. So let's remove this silly indicator here. Let's remove that. And let's remove the 5 and the 21. And let's just specifically talk about levels. What would be reverting to the mean on VX? Reverting to the mean puts us back down at 19. That's what it is. That's what it is. So what happens if we start going higher? Well, I'm going to take my stop loss. I'm going to lose several thousands of dollars, but that's okay. I don't mind. Am I trimming out of my position quite yet? No, I'm not doing that. I'm waiting for us to start trading higher. If you want to take your stab at this, if you want to say, nope, I think that the bottom is in and I think volatility will subside, then just consider some of the things that I'm showing you. That's okay. So just consider, but we will revert to the mean. I mean, it's going to happen. It's going to happen. I just don't know when. Don't ask me, hey, Sage, how many days or how many weeks is it going to? I have no idea. I have absolutely, but I know that it will. So that means that just trailing off of the first target, that's 30%. So how many ticks, or excuse me, how many points would that be? That would be 10 points. What if I want to go a little bit lower? Now you're starting to do some math. If each point is $1,000 and you're moving 10 lower, then you could potentially make $10,000 on just one contract. Yeah, that's exactly what I'm saying. If you're doing VXM, then it's just going to be divisible by 10, all right? Make sure you understand the math, and I'm making sure that I'm just thinking to myself that I'm explaining this correctly because this is very important. So what happens if I take, right, my entry was all the way up here at 37. What happens at 37 when we actually do start reverting to the mean all the way back down here? So that means that, you know, I'm expecting for us to move off of this high, maybe not now, but sometime here in the future, moving off that high by anywhere between 35 to maybe 50%. So when we do eventually revert back to the mean, that's 18 points that I'm looking to capture there to the down. It's going to be slow. I know it's going to be slow, but it's going to happen. I can guarantee you that it's going to happen. So you can do the math on this, right? So what am I saying to you? Look at all the levels that I have. If you want to take this as a mental exercise, I'm cool with that because this is not easy stuff. This is not for the lighthearted. So we had a huge dip here because of that 7% intraday move on SPX, right? At one point, I couldn't believe how much money I was up shorting the VIX. I really couldn't. I was like, it was astounding, but it reverted back. So what am I waiting for? I'm either waiting for us to break above 35 again or for us to retest. I would probably say a retest back up to $38. So between 38.5 to about 39 is what I'm specifically waiting for. Now, let's look at thresholds again. Why these levels? Like, well, you're probably thinking, like, why the hell does he have these levels? It's just because of this, right? How many times have we reached 33 or 35, 33, 35. How many times do we touch 35 and then sustain those levels? Never. We never, ever, ever sustain those levels. We might do it when we're more highly elevated on volatility, but you're talking about the 2008 crash. You're talking about the flash crash that we had in 2010 when I first started trading. And then you had this where I lost considerable amount of money my first 2 years of trading. Cool. So you have that, but for how long does that sustain? Do you see what I'm saying? So that's why I'm saying, look at the expiration. Specifically, what is your time horizon? If you're thinking you're going to make a quick $100,000, think again. It's not going to be quick. It's not going to be quick, but it's pretty much, I don't want to use the word guarantee, but there's a that's the right terminology. There's a very high probability that that's going to work out. Now, let's just say you can't trade futures. I'm going to give you the options here. Instead of doing that, I'm going to do this real quick. I don't want to spend too much time on this. Instead of doing the futures, you probably want to do SQQQ. So how are you going to trade that? You're just going to sell the shares. That's all you're going to do. So how much movement are you looking to capture? What is the risk reward? Well, it's about 30 to 40%. But Sage, what if we go higher on volatility? Then you have better risk reward. It's not that hard. It's really not that hard. Don't overcomplicate it. So if you want to do this with $10, that's fine. You do it with $10. So you want to sell short the shares. Sell short the shares. You want to short volatility. That's what it is, 35%. So if I have $1,000 and I want to short volatility, what would be my expected return if I were to take this at the top of that red, right here, atop this red threshold, and then write it all the way back down here? You're going to make 35%. That's what selling short is all about. So you can do that with this ETF. Another option that I would consider is going to be UVXY, right? So pro shares short. I believe this is short. Let me see. Yeah, short-term futures ETF. Okay, so this is shorting specifically the futures. Does this have more risk reward than SQQQ? I would probably say that yes. I would confirm that it does. So this, instead of doing 30%, you're looking at about 40%. Now, what's going to happen? Well, I'm going to tell you what's going to happen. You're not going to fall like a rock, right? Because you're waiting for the market to start picking back up. The way that volatility works, just because the market starts to recover a little bit doesn't mean that volatility just goes down. That's not how that works. Volatility will subside and go away pretty slowly, but it generally takes more time for it to subside than it does for it to pick up. Volatility is just volatility. It's going to ramp up extremely quickly. That's exactly what happened here. So those option contracts that you bought, those calls or those puts where everyone's complaining that they're very expensive, it's because volatility has expanded. This is the reason. So I would say that the three options that we went over, VX, but more specifically for the smaller traders, VXM, I think it's a very good option. And then also UVXY for shorting the ETF, not going long, and then shorting SQQQ. I think that these are going to be, in my opinion, three of the best options. I'm going to go the futures route this time. I have shorted the VIX before, but I want to make a very, 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 very clear comparison as to why I'm not going to be shorting the VIX at this time. It's because the risk reward is not that good. I have generally always shorted volatility with call credit spreads. I'm going to explain this for educational purposes. If I want to short, I'm usually going 99 days out, right? I want to be very sure of the money that I'm going to make. I've literally built my fortune on shorting the VIX. Literally, that's literally what it is. So I don't want to short with a call credit spread at 50, 55. Why? Because I don't want to put up $450 to make $40. That's just terrible risk reward. So how do I do it? These cannot be exercised early because they're European style. So I'm going to go in the money. This is how I've always done it. I don't buy puts on the VIX. That doesn't make sense at all. Why are you going to buy puts on volatility when you're waiting for volatility to expand, not contract? So if you're buying puts, you can make a little bit of money. It makes sense for you to buy calls on volatility because you're waiting for volatility to expand. It doesn't make sense for you to buy puts on volatility when you're looking for it to contract. That doesn't make sense to me at all. All right, so let's just say we want to go deep in the money. What is the relative medium for the VIX? I'm going to tell you what it is. It's between 12 all the way up to 16. 16 is right around the sweet spot, right? 12 is when we're extreme low volatility. So I'm going to look at the 20 strike, and then I'm going to look at maybe the 22 strike. Look at the risk reward. It's still not that great. Now, if you know anything about option pricing, I don't want to insult anyone's intelligence. I really don't, because all of you are from different backgrounds. You have different experiences. But this right here, for the threshold that you're going in, for how deep you're going in the money, this is ridiculously stupid risk reward. It just doesn't make sense. I used to, at one time, get 150 to 180, sometimes 200% return. But I think that the market has caught on to my strategy after 12 years. So before, I'll just give you an example. Just check out what the threshold is if I go in the money with a put credit spread. Just check this out. This is ridiculous. But look at the risk reward. Why? Because we all know that we're not going to be trading above 65 and we're not going to sustain that. So the risk reward is unbelievable. Before, this is what it used to look like on a short position. I'm going to give you a visual element because maybe some of you are still not getting this. On the curve, right? If I'm looking to take a short position, literally short volatility, or excuse me, in this situation, look to go long volatility. Look at where I have to be. I have to be above a specific threshold. In this situation, I have to be above 65. So that's why the risk reward is so good. It's absolutely fantastic. But look at the probability of profit. Just check that out. The probability of profit is 23%. It's extremely, extremely low. Now let's go back here to the table tab and let's do the example for the short. Let's look at the out of the money probability as well. This probably is something that shouldn't surprise you, but the out of the money probability here is quite high. There's a huge skew. There's a 20% skew for the puts because everyone knows that volatility will subside. It is the most, I mean, it's one of the most tried true things about the market. If you don't know that, I mean, you should study up for sure. So what if I don't want to go that deep in the money? What if I don't want to do a 2025? Well, let's do 25, 30, right? It doesn't sound too bad, but look how much money I have to put up. Let's just say I want to take 100 of these contracts. This is going to be way too expensive. You are deploying way too much mass, way too much money for little capital. That's why I don't want to do that. I would prefer to short VX or VXM. That's why I'm considering those options. I am not going to get the substantial return that I have once gotten. So hopefully in this explanation, I've been able to explain to you why it is that I'm choosing one option or the other. You might just say, Sage, why don't you just buy the puts, man? That just makes sense. You can do that, but look at the spread. I don't like that spread. I don't want to be paying an uneven price. If you want to go for a 20 put and you want to pay a spread that's almost $2 wide, that's cool. You can do that. Now, know what option, how options get their pricing. Option gets their pricing based on volatility. They're horribly inefficient the longer time frame you go. So if you go to buy puts or calls for longer dated time frames, why do you think so many of those contracts move stupidly well? Because if you get the directional bias right and you get some volatility moving in that direction, then you can make a crap ton of money with options. But here for relatively, I wouldn't call this really too long time frame, but medium time frame, this is going to be priced pretty efficiently. So how much can you make off of this position if the VIX were to go to 20 in the next month? Maybe you'll make about 30, 40, 50% on this, but it doesn't really look too good. For the amount of money that I need to deploy, 30, 40%, I would prefer just to short the shares because these are going to be susceptible to theta decay. I don't want to be susceptible to that. If I'm going to take a short position, I can pretty much guarantee that I'm going to make 40, 50%. Then I'm going to go the shares route where I don't have to worry about theta decay. Does that make sense? All right. So that's what I have for the volatility stuff. So I talked about the 4 trades that I've taken, right? I talked about the reviews. I talked about just my breakdown and my thought process, the way that I'm using quantitative analysis now more than ever. Now I want to go over some of the stocks that I'm ready to buy into. So I'm not going to give you, hey, I'm buying here, I'm buying now. I'm not going to be doing that because that's reserved for the Discord. In the Discord, I will be discussing what I'm adding to, but I want to give you some considerations. I would not be where I am if I don't pay attention to specific. I'm so sorry, this dates me, but if we don't pay attention to intrinsic value and valuations on companies that actually matter, then what are we even doing, right? We have to pay attention to stuff like that because price is not always going to reflect the value of the company. I know that sounds weird, right? Everyone that's under 28 years old, it seems like everything is all about price. It's not about price. It's about valuations. Are we going to be hitting valuations on tech earnings in the next 2 to 3 months? We don't know. That's what all the pricing models are being done behind all the corporations and all the people that manage their hedge funds. All of them are doing that even as I'm making this video. All of them are saying, all right, if we're not hitting our price targets here on tech earnings, then what exactly are we doing? We need to reevaluate what our expectations are. That's what the market is about. If you think that the market is anything else than that, then you are sorely mistaken. The market is all about expectations and meeting them or not meeting them. We have gone away from the standard for the dollar. We've been away from that since the 70s. It's the same thing with valuations in the market. We have not gone off the standards of pricing efficiency or just PE ratios. We have not gone off that model strictly based off of intrinsic value for years now, literally for decades. So when you're looking at evaluations for companies in environments like we are now, it really, really does matter if a company can hold its shit or not. That's basically what it comes down to. So how close are we to intrinsic value? That's the question that you need to be asking yourself. So with that being said, I hope I built this up so you guys understand where I'm coming from. I'm not just looking at levels. I'm going to talk about levels extensively. I'm going to give you all the technical analysis that you can ever want. But all the companies that I'm going to mention, they're all based off of an intrinsic value. If they do not have intrinsic value, I couldn't care less about them right now. All right. So I'm going to mention 5, maybe 6 stocks here or ETFs that you already know about, but I'm just waiting for signs for me to buy into them. So the first one is going to be Apple. All right. It's going to be the most boring choice that you can ever imagine, but it's going to be Apple. On the daily time frame, just look at where the voodoo lines are. We have massacred these levels. On anything, we've massacred these levels. I have never, ever in my life, not even studying history, Never in my life have seen the price action that we've seen. No one ever has. People that have been trading for 60 years have not seen the environment that we're currently seeing. So let's take off the voodoo lines and let's just talk about retracement levels. I want to base my retracement levels not on this, but specifically down here. When we're talking about evaluations, do your own due diligence. Don't just go off of what I'm telling you. But I want you to just, I mean, Apple has pretty decent evaluations. That's what it comes down to. So let's do some retracement levels. Let's go here and let's start all the way here from the bottom. So what are Fibonacci retracements? If you never heard of this before, let me put on my educator's hat here for just a second. These are just going to be mathematically significant levels that you can retrace back down into and potentially hold for thresholds. So buyers are generally looking for these levels to look to to buy into the level once again. So the most significant retracement levels are going to be as follows, and this is why I had these levels on my chart. They're going to be the 0.786 level and then all the way back down here to the 61.8 levels. I use different ratios on my other platforms, so that's why I got mixed up there just for a second. But let's do this on a percentage basis. 61.8, and then we're going to go all the way back down to 78.6. So check this out. If you don't use Fibonacci retracements, I'm going to blow your mind right now. These are mathematically significant levels just based off of nature. I'm not going to go into the computations or even who figured out that Fibonacci's could be applied to trading. That's not important. But what is important is for you to recognize these two thresholds, the 61.8 level, and there's so many other YouTubers that explain this so much better than me. I don't have the time to do that right now. And then all the way back down to 78.6. At these incremental levels, this is where you generally are starting to look for some sort of reaction. So let's bring back the voodoo lines here for just a second. The voodoo lines are telling me, okay, so I have a fire line right there, and that lines up pretty nicely with the fire line as well. I'm sorry that this chart is busy. I know that it's very busy. But what are the retracement levels? It's pretty close. A lot of what you see with technical analysis, it has a lot to do with confluence. So you're waiting for as many confluence factors in order for you to make a mathematical, quantitative decision. There comes that word again. It's not about you trying to time the bottom. Forget that, right? Because timing the bottom is an emotional decision. I'm not interested in emotional decisions whatsoever, right? Because you're going to erode from the inside if you want to make everything emotional. Don't make emotional decisions. Make calculated risk decisions. That's how you're going to be successful as an investor and also as a trader. That's the kind of person I have never changed that. Ever since I started trading, that's how it, and I'm constantly looking to improve that. So check out that level right there. It's at 175. And then what is the other significant level? If we get back down to 155, I'm looking to buy up Apple quite significantly. We don't have to spend more time on this. That's what it is. If we get back down to a full retracement, how do I anchor the fibs? I anchor it from the lowest point that I can find on the chart. Right here, I'm using the daily time frame. If you want to use the weekly, that's fine. You want to do the following. I did something that some of you might point out and say, Sage, you did something incorrect. The lowest, most recent point is right here. You're correct. You're absolutely correct. So let's modify this real quick. So if I were to do the lowest point, we're already breaking within the threshold here. I'm not looking to do the daily time frame. I'm not looking just to do the daily time frame analysis because I think we're past that. The reason why we're past that is because I'm considering the 200-day moving average. If you follow along with any technical analysis that we have in the market, the 200-day moving average is probably going to be the most significant moving average for any of the boomers or any of the older traders. We're past that point. So I have to give consideration, and this is kind of funny how this works too. We're bouncing very close to that threshold, the 78.6 level, but I'm going to go a step further behind that. I'm going to anchor it off of this point. I'm going to anchor it not off of the first low that we've made past this trend that we have right here. I'm going to go just a little bit further back. Both of them are going to be part of the overall analysis, but I've chosen to do this particular point because I think that there is a more gargantuan move that was made off of that point overall. Hopefully that makes a little bit more sense. I can't just pick arbitrary levels. I can't just say, oh, I'm going to use it off of this point or this point. You want to go for the lowest point where you've seen the biggest move. That's generally how I do my calculations off my fib retracements. So if we're starting to encroach upon one particular threshold, then I'm going to the next one where we had that significant move off of. All right, next, let's talk about NVIDIA. NVIDIA did have a really nice bounce today. Let's see what our fibs have to say about that. I'm going to give you some levels, and then we're going to go through this pretty quickly. I don't want this to be a 2-hour long video. Let's go to the fib retracement tool. So we have this actually, we have this one right here. So we have that one. We've already penetrated below that. So let's go to the next one after that. You have there. All right. So you had a one-to-one retracement. And then let's go to the next one after that. So, okay. So what are we looking for right now? Now we're looking for 78.6, and then we're also looking for 61.8. We've already broken below those thresholds. So what is the next level lower possibly that we can see on NVIDIA? Well, for me, that's going to be all the way back down to 75. I've already said it during my sessions, my power hour sessions, that I am interested highly in NVIDIA between 78, it's right here. I'm not gonna work twice. Around here, the weekly time frame, that's where it is, between $75 to $85. At that point, I think that evaluations are fair. Can we break even lower and then trade back down to this threshold? For sure. This is going to be a swap area. Let me explain what swap means. Swap is going to be a previous resistance area that might act as a support. So that's what we're doing right now. All of these support areas, now they become resistance because they swapped. So I'm waiting for that $75 area. If we do trade back down that low, we need to sell off an additional 27 points here. If that is the case, then I'm looking for that to be the next swap area or the next support. Why? Because previously it was resistance and then it acted as support. So coming back down to it, I'm going to wait for it to act as support once again. So let me go back to NVIDIA. So that one area, let's use the swap concept here. That one area that was previously resistance, let's see if it's going to act as support. Right now it is. Right now it's acting as support. Are you going to use fib retracements by themselves? No, you shouldn't do that. You should be using your moving averages as well. And then you should be looking for signs of capitulation. So what am I specifically looking for me to start buying into NVIDIA? That's probably the question that you're even here watching this video for. I'm going to tell you what that is. For me specifically, I'm waiting for the 5 and the 21 EMA cross on the 4-hour time frame. If I don't get that, I'm not interested. I need to wait specifically for that until I'm looking to buy in. Why do I have that particular level? It's a trick that I've learned in the market. When I'm on the 4-hour or the daily time frame, if I want to use the daily, that's fine too. I want to know when the short-term traders are now overcoming the medium time frame traders. So what that means, just let's break it down, right? Let's not make this complicated. The short-term bulls are overcoming the medium time frame bears. When that happens, usually, not always, but usually when that happens, then we start moving into momentum and starting to see that particular stock starting to trend for a little bit. So what did we have on the 5 and the 21 cross? The last 5 and 21 cross that we saw off of the daily time frame, that was a bearish indication. That's what it was. It literally was that. So obviously, I didn't think of this in hindsight. I didn't say, NVIDIA is now crossing between the 5 and the 21. And I'm going to short the crap out of the market. Obviously, I didn't do that. That's why I'm down 50% of my net worth, right? Because I didn't make that part of my consideration. But recently, I'm going to share with you a little trick, right? If you made it to this part of the video, I'm going to give you a nugget here. If you're an investor, if you are doing this long term, if you're a little bit older, I'm going to give you a little bit of keys to the castle here. On yin, I did this recently. So I have my 5 and my 21 cross. I took my position off at $44. So now I'm looking pretty clever on this. But my moving averages, if I just put my indicators on there, I bought this right here when we were looking at that break. I actually bought it a little bit earlier. I bought it at $19. So I moved up on this and I didn't cut my position here. Why? Because we were moving a lot because of stimulus, specifically because of that. So I was thinking for the conditions that we have, it seems like this is going to hold up pretty well. But where could I have taken that position off in order for me to not substantiate any drawbacks on the position? You're probably thinking, Sage, I think I know what you're getting at. Maybe I should have taken off my trade right here, or maybe I should have taken off my trade if I'm looking at the 4-hour time frame, maybe a little bit earlier. I think that that's common practice. So I didn't do that here. Now, with all this kerfuffle that's going on with current policy adjustment, and the trade war that we're currently in, I did do that when we were getting back here to $44. So it doesn't have to be exact. It doesn't have to be 100% exact, but more or less, I took that as my indication for probably want to get the hell out of this trade. So that's exactly what I did. And now the Chinese stock market has recently just sustained its worst trading day in history. It was down 23% today, or maybe even a little bit more. This was absolutely not even horrible. Horrible is not even, it doesn't justify what happened to the Hong Kong index. It was just absolutely obliterated. It was taken off the face of the earth. That's basically what happened. Okay, so let's go back to some of these stocks that I would like to discuss. So first and foremost, what did I discuss? I talked about NVIDIA, and I also talked about just certain positions that I'm considering. So let's go a little bit step further, right? Let's also talk about Google here. Google, I think, would also be an extremely good consideration. I also talked about Apple, excuse me. So on Google, I'm gonna tell you that I'm already in the position. All right, I've already taken the position because I took the bait right here off the 4-hour time frame. Just in case anyone is asking, why did say it's screwing me over here on Google? I took Google because I thought I was taking this as indication that we were looking to recover. I was wrong. I was slapped as soon as Liberation Day reared its ugly head. I was slapped and I didn't have the opportunity to get out of the trade. Now I don't want to lock in the loss. I actually want to add to this trade. And I will be adding to Google. There's no question that I'm going to be adding to Google. Do your own analysis. But for me, they are close to intrinsic, not perfectly, but they're one of the most fair valued companies on planet Earth right now. So let's remove the 5 and the 21. And let's just look at where we're going in terms of retracement levels. So we already broke here, right? Let's talk about that specifically. We already did a one-to-one relationship from that top. Now let's anchor this a little bit lower to the next lowest point where we saw the strongest move. Where are we trading back into, or where did we see some sort of reaction? We saw it at 78.6. Did we have a reaction off of 68? Yeah, we did. So I got clapped. I got clapped, right? I literally got clapped. I am down several tens of thousands of dollars on my Google position. Why? Because I thought that looking at the 4 and the 20, or excuse me, the 5 and the 21, and looking at the retracement level where we have some decent support, I had the proper risk management on this, but I didn't have the opportunity to trigger the stop loss because the next 3-4 days we were down 15% on Dow and IW and whatever. We were down on every goddamn thing. So in this situation, I got clapped. That's what happens. And I have several people that are clapped with me. But I know that if we continue just to analyze this and be a little bit more, instead of emotional, be a little bit more on the calculated side, I think Google has a pretty good launching pad here for us not to see a V-shaped recovery, but start to look at valuations. Not just specifically price. I'm down 15% on this trade. But not specifically just price, but just looking at the long haul on this. The more we pull back, right? I have this blue area for me. The more we pull back into the 135 area, I think we have that one-to-one relationship, what I'm specifically looking for. So we have Apple so far. We have NVIDIA. I've already shared with you those target levels. And then we just went over Google. Let's talk about 2 or 3 other stocks, and then we'll call it a day from here. I'm just, going to go box and go do something just so I can keep my mind off of the market. Remember, I'm running on 36 hours where I haven't taken any sleep. All right, so we have Google here. We have Apple. Let's see what else I want to buy into. I do want to buy into small caps. So small caps are going to be IWM. What I'm going to mention to you now is a very high risk reward. It is. It's a very high risk reward trade. However, you need to have the stomach in order to hold on to it. And what I mean by that is I don't want to take IWM per se, but I do want to take small caps that are leveraged. I like trading leverage. If it's not something for you, don't worry. No harm, no foul. But I do like trading leverage in situations like this because this is what I've done even before trading was popular, right? I've been trading for a while. So even before we had the trading community being what it is today, I was already on stuff like this. I was trading leveraged ETFs even then. So 5 and 21, right? I got to bring that up. Off the 4-hour time frame, I really don't have that condition that's being met quite yet. So let's use the retracement tool. Let's plot that on here on the top. So we already broke below several thresholds. So let's go to the biggest move that I can foresee here. Oh, that's the wrong tool. Sorry, I'm running on 36 hours, guys. You guys have to be patient with me. So retracement, long position, retracement. Let's do that. All right. So where am I reacting off of? I'm reacting off of 78.6, but my gut is telling me maybe don't want to be taking this position here, but it's a conscious level that I have off of my fib retracements. When I start seeing that sign of that 5 and that 21, I thought that I had that BS here, right? And let me show you why I took the trade the way that I took small caps here recently. Let me tell you why I did that. Let's use the 5 and the 21. The 5 and the 21 was crossing right here, and I thought that I hit my threshold. I thought that I hit my stride, but I was wrong, right? I took the position. I thought that we were going to start recovering here, and then bam, I got side slapped. I got side slapped by the president of the United States. It is where you are politically. I want to be completely respectful, but let's call a spade a spade. It's because of policy. It's not because of anything economical. I'm sorry, but it's not. It's more because of policy. I apologize of where you are on the spectrum. I get it. I want to be respectful to my counterparties, which I always am, but it's because of implementation of policy that maybe has been done more drastically than what is civil. Let's leave it at that. All right, so some levels that we can trade back down into that I'm watching myself off the 5 and the 21. Let's get rid of that. I'm looking for specifically a 1-to-1 retracement back down to 165. Let's see what the voodoo lines have to say about that. So that lines up pretty perfectly with the fire line. That doesn't surprise me. I know how the fire lines are calculated. So when I'm pointing out these levels for you, it's not because I have an opinion on what the levels are. Screw my opinion. My opinion doesn't mean a goddamn thing. It means jack shit. My opinion doesn't mean anything. Opinions on CNBC pretty much mean jack shit. Their valuations and their analysis, I mean, I pay attention to them because I want to know, is there by the dippers or what's happening here for XYZ hedge fund? Of course, I want to know that kind of stuff. I want to know when large money is moving in or not. But I'm looking at technicals. If the technicals make sense, if the valuations are making sense, which is something that the chart doesn't show you or tell you, if the valuations are starting to make sense, then I'm making a sound judgment based off of price, which is not going to be at the forefront, but more so valuation. Is there value there or not? For me, I think that IWM, although it will take longer, small caps are going to be wiped out, right? This is why everyone is rotating out of small caps, because small caps are going to be absolutely destroyed in this tariff environment. Destroyed. This is why I'm not looking to jump into small caps, at least not as aggressively as I am with some of the other stocks that I mentioned. Okay. So last thing that I would like to mention, I'm not interested in Tesla. Hell to the no. Am I interested in Tesla? Not even. Let's not even waste time with it. Last thing that I would like to mention is AMD. I bought into more AMD today. I did, and I'll tell you what. So AMD, looking at values once again, that full retracement brings me back down to $55. We're at the 78.6 threshold. That's where we are. So I'm making a bet here. I'm taking a position where I'm looking at a little bit more longer term. So if I'm looking at potential risk reward, I'm already down on AMD, which I took at approximately 120. I don't pick these levels out of nowhere. I took 120 because I thought that the 61.8 level was going to hold. I was very wrong, extremely wrong. But that doesn't mean that I can't make this trade work. I'm pretty good at taking wrong decisions or taking trades like this and just being level-headed about them and making calculated decisions on how I can revert them into winners. This is one of the biggest reasons why I've been successful long-term. So what am I looking in terms of risk reward? Let's not even take it all that high. Let's just say we go from here to here. What's that measure? Let's take our measuring tool. Where is our measuring tool? That's a fib retracement. Our measuring tool is right here. And how much can I perceivably make if we start making a recovery? 75%. I'm already down quite considerably on AMD. I'm not going to pretend that I'm not. I'm not going to sit here and say, oh, I bought into the best time on AMD. I'm not going to do that shit because that's not who I am. I'm down considerably on AMD. But I added to the position so I can average in and take my overall average dollar amount, that 120, take it from that, and then just make it in possibly 102. If I do the calculation, I'm in AMDL, excuse me. This is 2-time leveraged. My average on this currently is about $5. It's about $5, $5.20, maybe $5.30. I have to do a little bit cleaner math, but it's not going good. I'm down 40 some odd percent. But just look at what my upside can be. You don't have to agree with me. You can say that you're a jackass, dude. You have no idea what you're doing. That's fine. I think that now I can accept that criticism and I have to be quiet about it. I can't sit here and then try to defend myself. Why would I do that? I rather focus on what I can do going forward rather than think about what it is that I did incorrectly in the past. I don't like doing that. I want to learn from my mistakes and then from there say, all right, what did I do incorrectly? And can I identify those circumstances for me to do better the next time? I think that if we apply that as traders, then we can not only become better financially, but also better in how we do our calculations and how we think about the next setup or the next trade or the next investment opportunity that we have going forward. That for me is more of a better use of my time. And also I think it really helps out the psychology of the traders that are following me as well. I don't know. You guys can leave some feedback. I'm sort of venting right now. I'm running on 5 coffees, so permit me. After this, I'm probably going to lie down for a couple hours. So what do we have in terms of risk reward? Risk reward here. I think if we get back up to the $8 threshold, risk reward is about 160%. Can we go lower? Can we trade back down to $1? Absolutely we can. But now I'm thinking about AMD as a long-term investment. I'm looking at valuations for the company in particular, and I'm looking at infrastructure, and I'm looking, are we going to be taking out NVIDIA or AMD anytime soon? In my opinion, I don't think that we are. I honestly don't think that we are. So take everything that I've said thus far. There's a whole bunch of other things that I can analyze, right? There's a whole bunch of ETFs that I'm very interested in getting into. The only thing that I'm going to mention outside of what I've talked about so far, it's the only other thing that I would highly consider all of you maybe take a look at, is going to be 3 times leverage QQQ, which is basically TECL. I'm down a bag on this too, right? I'm not going to sit here and bullshit and say, hey, I'm doing real well in the market. I'm not going to do that. No, that is not the person I am. I'm being absolutely slaughtered in the market. Despite the fact that I did well with my futures trading, and despite the fact that I made a lot of money on futures today, it's not compensating for where I am right now on my shares positions. But I know longer term, I know that if I'm applying myself and applying some of the stuff that we're discussing here in this conversation, that we're probably here almost about an hour, if we're looking to analyze this and look a little bit longer term, I think we can make it out the other side better than how it is we started the year. Does that make sense? So let's say I'm down 40% of my net worth. Maybe at the other side of this, I can be up another 40, 50, 60, 70, maybe even 100% of my net worth where I am now. I think that that's where I am, right? That's where I am, and that's what I want to convey to you guys. What do we have on TECL? Let's use the retracement tool. I want to use specifically that. Let's go here. Let's use that. And where's the lowest point that we can have that we've already broken threshold? No, that's not going to work. That's going to work for us right there. So I used the wrong tool again. My eyes are going. All right, retracement level here. Sweet. So have we already hit the one-to-one relationship? It kind of looks like we did. So let's pull back a little bit further. Let's go back right here. So we've already broken 78.6. We're pretty much close to a one-to-one back down to 26. We're trading right now at 39. Do we have a support level that we like? I honestly don't think that we do. I think we have to wait just a little bit more. So what I'm looking at for on the weekly time frame, on the weekly time frame, I'm waiting for about 25 to about, I would say $30 before I start buying into this again. Just look at that massive, massive sell-off. If we are to get even 50% of this sell-off, if we start to retrace back up 50%, this is already going to be worthwhile, in my opinion. Do I want to be buying into QQQ and SPY at this moment and wait for, a 20, 25% return? Honestly, I don't. I would prefer to chase better returns, which obviously inherently is going to have more risk. But in this situation, I think if I wait long enough, which I'm already in this trade, I'm down 27% on this trade, 27%. And this is a large position for me. I think that if I average onto this position, I think I can still make it out on the other side. I'm going to wait until I add overall to my swings or even start signaling additional swings. But I think the TECL, when we're talking about risk reward, especially for shares, I think it's going to be worth it. Cool. Let's see how much perceived downside we can have from here. Perceived. I want to use correct terminology. We have another 30% that we can move down from here. Is it going to kill me? Yeah, absolutely. It's going to kill me. It's going to kill me when I go to do my taxes? Yeah, of course. Of course, it's going to kill me when I do my taxes. But what is the upside that I can possibly see from here? Maybe about another 100% if I average into the position overall. Okay, those are my recommendations. I apologize if I said anything that was too abrasive. I'm tired, and I'm gonna go have my adult nap after this video. But if you guys have any questions, comments, or anything that maybe you want some clarification on, let me know in the comment section. All right, let's have a conversation. I don't want this just to be one-sided. If there's anything that you're saying, hey Sage, maybe this was a little bit off, or you could have clarified a little bit better here, I'm always open to feedback. Always, because I always feel that we as educators and we as traders, we can always look to improve. And that's what I'm looking to do for this phase of my career, and also in this freaking just absolutely erratic environment. All right, thank you guys for watching this video, and I'll give you the breakdown after I get some rest and, hopefully catch some banger trades tomorrow as well.